Greetings traders and welcome back to today's video. In this session, we'll be revisiting the concept of draw on liquidity, and more importantly, I'll show you how to act on it with extreme market precision. We'll cover when to trade, when to stay out, and how to maximize your probability for high quality trade outcomes. With that being said, let's get into it. So essentially today we'll be doing practical examples, right, over a duration of 2 weeks. 2 weeks worth of price action. So we will be going back into time, a bit of back testing, but essentially revising this video right here that I did in June, which is premium and discount price delivery in institutional trading. This video, along with mastering institutional order flow and price delivery, these two videos help you to understand draw on liquidity with extreme precision. They help you to understand where the market is most likely going to draw to next, right? So I will attach these two videos along with this one so that in any by any chance if you haven't seen them you can also watch these two, and then what will help us you know trade actually trade based on the bias or act on the bias is quarter theory, which is mastering algorithmic price movements. So this will help us to enter the market with extreme precision. It will help us to understand when to trade and when to stay out of the markets. So all of these three videos for you guys on YouTube, you'll find it under the high probability trading zones playlist. And all you need is these three videos in order to, maneuver the market, right? And I'll show you how you go about doing that. So with that being said, let's get into it. So let's start with draw on liquidity. So what I want to do is I want to go back 2 weeks. So this is okay, this Monday. So we'll go back 2 weeks all the way down there. And then I want to show you how you can then understand where the market is most likely going to draw to next. So we're starting with draw on liquidity. So the first thing you need to understand is what is price action doing? So we understand on NASDAQ that we've been bullish overall, right? And we understand that this is an intermediate term low, that is our intermediate term high. So immediately we want to see where price is in relation to premium, which is above the 50%, and in relation to discount, which is below the 50%. So we understand that the 50% is our area of equilibrium, our point of fair value. And banks are very interested in this point. They trade according to premium and discount levels. So we've already established in those three previous videos that the market is delivered by an algorithm, and that algorithm is controlled by smart money, and smart money is the banks, right? They determine where the market is most likely going to draw to next. So what has occurred in price action? The market moved from an extreme premium price, where we understand that the banks in this instance have been distributing sell orders. They're distributing sell orders at premium prices to do what? To book against discount sell stops. To book against implies that they're going to basically scale out their positions at discount prices because they've been selling at a premium. So we see that price moved heavily into a discount price, and then immediately what we understand, these lows possess what? Sell stops, right? So we can see that they are discount sell stops that rest down here. So they sold at a premium, and they're going to look to buy back those positions against sell stops, which are resting where? At discount prices. So these are discount sell stops, right? So the moment we hit these discount sell stops, that's why we start to see this heavy rejection of price action. That gives us an indication that smart money is now scaled out their position and they're buying against these willing sellers, right? At a discount price. We've also hit our 79% level, our 69 to 79% level. These levels are high probability levels where you will most likely see reversals within the market. Another thing that we see that is aligned to these levels, which is also at a discount, is what? this bullish order block, right? Okay, cool. So we have this bullish order block, which is in heavy discount price action. And what we see, once price has hit this level, we start to see heavy rejection towards the upside, implying that this order block is in fact a strong institutional support zone, because we see that this daily candle as well closed above that point. So we're getting an idea that this low may have been set, and then what we'd most likely see is price starting to push towards the upside. But what is the narrative behind that? Why is price action now looking to push towards the upside? These sell stops at these lows, because we understand that, you know, large funds which exist on larger time frames, not retail traders like us, we have small funds. There are larger funds which are like for instance, prop firms, or what are large firms like hedge funds, and all of these large funds are also trading the markets, and their stop losses exist at these lows. And we don't know how much worth of liquidity exists there, but it's a lot, right? So the banks are interested in that liquidity. That's why they'll draw the market there. So these are seen as willing sellers at a discount price to buy against. So if the banks are accumulating long orders here, where's the most where's the most fair value point or price action where the banks will most likely look to start scaling out their orders? So if they bought at a discount, the one point in which the market is most likely going to draw to next is the area of fair value, because according to the banks, this is a point of fair value for them to start booking their profits. What exists above the 50% level? Buy stops, right? So they've bought against sell stops at a discount. They are most likely now going to look to target buy stops that exist at a premium, because they need to book against those buy stops. So we understand that there are premium buy stops over there. So that's how trading works. If you're buying against a discount price, in a discount price, let's say, for instance, you've bought this 17.9 level, right? You've bought a few positions at that price. The moment price pushes towards the upside, you're going to look to sell your order at a much premium price. That's how you make money. But if you've bought at this point, at this discount price, and the market continues to deliver more discount prices, you're going to eventually have to buy back your order. It gets bought back at your stop loss. So if your stop loss is here, what happens is you've basically bought back that same order at a much lesser or much cheaper price. So that's how you lose money. So that's how the banks work. They've bought at this price, they need to take profits against buy stops which exist where? At a premium. So that's why our next draw on liquidity is our area of fair value, and then our premium buy stops. Right. So we're anticipating bullishness. There are more buy stops that exist up there, more buy stops exist up there, and then up here there are even more buy stops at a nicer price, at a much larger premium price. I hope the drawn liquidity makes sense. But now let's get into the how do we go about executing price action according to what we're anticipating this bias towards the upside. Cool. Let me just show you something on the weekly time frame. So this is Nasdaq still on the weekly time frame. We understand that we've established our low. At least that's what we are assuming at this current point in price action. We understand that we want to see price push into an area of fair value at a premium, right? According to the weekly time frame, what PD array or what premium array rests in premium prices? We understand that it's this fair value gap. So on the weekly time frame, it's suggesting that we most likely want to see price continue higher as to reach that level over there, right? So that is our weekly draw. But another thing, and I spoke about this in the quarter theory video, this video over here, right? We're anticipating bullishness in the weekly candle, and that goes into candle anatomy, right? We're anticipating bullishness, so we want to see the next weekly candle be a open, right? We want to see open, form a low, and then trade against the low to be a bullish candle. The same way this candle did what? So we get the open price, right? The candle first establishes its low. That low is established through manipulation. The low is then established. That's where we want to buy price action towards the upside. So anticipating bullish close candle, right? I hope that makes sense. Look at this candle. We're anticipating a bullish close candle. So the first thing we want to see is a push towards the downside to establish the low, and then heavy distribution to establish the high, and then the candle closes. So how do we go about, you know, seeing that play out on the smaller time frame? How do we go about trading that bias towards the upside? Let's go on to our H1 time frame. Okay, cool. So this is Monday the 5th. That is that daily bullish order block. These are those sell stops that we took at a discount price. That is our drawn liquidity first target, the buy stops. What's resting above that? That's that weekly fair value gap, right? In a heavy premium price. Let's just make that one blue. So we're anticipating bullishness. So how do we go about acting on that? How do we go about trading this? All we need is daily time frame and the hourly time frame. Now, this is quarter theory. We'll just quickly revise it, right? We spoke about quarter theory. If you haven't watched the video, please do. I released the video on Tuesday, right? And there I mentioned that that weekly candle can unfold in three different ways. Still the same bullish candle, but it can unfold in three different models, right? First model is called AMDX. Model 2 is XAMD, Model 3 is XXMD. So these are different variations of how the candle can unfold. Here's the key. So A is the accumulation, manipulation. You have distribution for D, and then X is a continuation or reversal. The rules are simple. All you want to do is, in fact, let's do it as I explain this whole thing because we don't have enough time. If you haven't seen the video, please do watch it. But I'll give you a bit of the rules as we unfold in price action. So quarter theory suggests that the first thing you do is you want to mark off Monday, 12 a.m. New York time. So this is the 5th of August. So you want to have a span of 24 hours and make sure that you are using the New York time, right? Span of 24 hours. So you want to have the whole price action, Monday's price action, until Tuesday, right? You're only going to consider Monday, Tuesday, Wednesday, and Thursday as your important trading days. You don't trade Friday, and you'll also discover that you don't trade Monday. I'll show you why. So the first thing you want to do is you don't trade Monday, you let Monday unfold. You let Monday play out in price action, right? The reason why you do that is because you then want to determine what type of price action did Monday deliver, right? So you have these models. You want to look at this type of price action and compare it to the model. So the first thing you want to ask yourself after Monday is played out, remember, you don't trade Monday. After Monday is played out, what type of price action is this? Is it accumulative in nature? Meaning, here's an example of a cumulative price action. Is it accumulative in price action, or is it trending or reversing, right? This is trend-like price action. So that's the question. What does this price action look like? Does it look like that or this? If your answer is this, then you're wrong. If your answer is that, then you're right. This is trend-like type of price action. So you want to denote it as an X, right? So you come back to your models, you can see that Monday was not accumulative, but in fact, it was trending, right? In price action, it was a continuation or reversal of price action. So you want to then denote Monday as an X. So immediately, another thing you need to understand is that you're only looking forward to trading after the manipulation has occurred. That's your trading day, the manipulation and the distribution. Those are your high probability trading days. Your X is high probability, but it's not as high a probability as these two, right? So you have an X. So immediately you understand that Monday is not going to suffice. You're not going to see model one play out within this week, whereas instead you're going to see model two or three play out. So you only want to trade the manipulation, right? So which means you wait out Tuesday. You don't trade Tuesday. Wait for Tuesday to play out. Tuesday has played out. Ask yourself the question, what type of price action does this look like? Does it look like this trend like type of price action, or does it look accumulative in nature? Which one of the two is it? If your answer is this one, then you're right. So then you mark this out as a accumulation because you can see it's sideways delivery in price action, right? That is your accumulation. What is this starting to look like? Look at your three models. What is it starting to look like between model 2 and model 3? Starting to look like model 2. So immediately you understand that this week is going to play out in this manner. It's going to be a model 2 week, an XAMD, which is continuation, accumulation, manipulation, and then distribution. So now what are you waiting for? You want to see price manipulate. If you're anticipating bullish price action towards the upside, and that's your draw on liquidity, then what you want to see is a manipulation towards the downside. Why is price manipulation My bad. Why is price manipulating towards the downside? Because sell stops exist down there. You want to see the wrongful move, the Judas swing. The manipulation is called the Judas swing. Why is it called that? It's called that because Judas in a farm is referred to a sheep, the Judas sheep. Its job is to basically lead the other sheep towards the slaughterhouse. But before the Judas sheep gets into the gates of the slaughterhouse or the doors, that sheep turns around and then the rest of them go in and get slaughtered. So that's why the market is doing exactly that. The algorithm is pushing price action towards the downside to entice us to sell price action, right? And then those sell orders and the sell stops that exist will be seen as sell stops existing at a discount price, in which smart money will then buy against that to push price into a premium, right? So what are we anticipating next? We want to see this low get taken out, right? That's our low. Price can go even lower than that, so we wait for this to occur. Now we wait for confirmation. So we see price goes lower than that, and it takes out even Tuesday's low. We want to see a confirmation. Now we want to actually trade the market. So that's our manipulation and price action, which occurred over there. So we understand that's our manipulation, and then Thursday we're going to anticipate what? A distribution of price action towards the upside. Now this is where you look at different or various types of confirmations as well, because you're an ICT trader, right? What do you have here? You have your fair value gap existing where? At a discount price, right? We're below area of fair value. We've tapped into our 62% level. We're at a discount fair value gap. All of this is advocating for us to look to push price into a premium, right? So don't cram this whole thing. Let the market play out and watch it unfold, right? And then you react to what has occurred. So what is this? We start to engulf that candle. That's a change in state of delivery, implying that this bearish candle is now a order block, right? And if price taps into this order block, I look to buy that. Let's see if price taps into that. Another thing, we're breaking bearish PD arrays. We've broken that bearish fair value gap over there. We traded above it. Here's a fair value gap. All right. Now I no longer need, of course, this now you choose how you confirm your entries, right? You go about doing that. You can enter off of that fair value gap. You can have an entry off of that. You choose that and you choose where your risk to reward is going to be, or all of those sorts of things. So we can see how we continuously respect that. Thursday, we're anticipating a continuation, a distribution, so that the weekly candle can form its high of the day or of the week, I meant to say. And then this low has been set. We see Monday set the low of the week, but this low has been set. Why? Because smart money, the banks have entered their buy order against these sell stops. So this becomes a high resistance low. We don't want to see price go against that. And then as far as targets, you target whatever you see fit. And then also go into how you go about confirming these bullish types of draws and all of that. So those are your models. Please do revise it. Please do practice this week's one, right? See how this week unfolded. But with that being said, best regards, the architect.